Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So, as many of you will know, I basically never talk about macroeconomic factors and what's happening globally. I really think your time is far better spent focusing on individual businesses and trying to figure out what the future of that business looks like and what you should be paying for them as an investor. That's what I dedicate most of my time to when I'm looking at investments. But the stock market is doing some very strange things right now, and it has been just to a certain extent for the last few years, to be perfectly honest. And I really think that some of the things that it's doing are down to two main factors, which is extremely low interest rates and a whole lot of money printing. So I want to give you my 2 cents on the topic and how I personally think about those things as an investor. Now, first of all, what am I talking about when I say that there's some strange things going on? It's a combination of stuff. So there's various metrics you can look at around the stock market, which really suggests that we're in very, very overvalued territory relative to historic averages, and there's definitely counter arguments on the other side in terms of very low interest rates and valuations deserving to be higher as a result of that. So if we look at something like the Shiller PE, like the Buffett indicator, which is the Wilshire 5000 to GDP ratio, which I've done a video on the channel on a couple of times before as well, we see that there are massive valuations compared to historic averages. The other thing that we're seeing at the moment is that we're currently in the middle of a massive recession due to what's going on around the world, yet we're seeing stock markets, particularly in the US, return to almost all-time highs, or even at all-time highs for a lot of individual technology companies. So some pretty unusual things kind of going on at the moment, and I want to get into my thoughts on why that's the case. So the first major factor which influences valuations generally, and I think it's quite important to understand, is interest rates. Now, interest rates, as Warren Buffett would put it, are like gravity on valuations. When interest rates are higher, stock market and asset valuations generally will be lower, and vice versa. When interest rates are lower, asset valuations will be higher. And that is for a couple of fundamental reasons. So essentially, when you're looking at an investment, you need to stack that investment, those investment prospects up against all of your alternatives. And the most commonly referenced alternative, particularly in the US when you're a stock market investor, is something like a 10-year treasury bill, a 10-year bond, often referred to as the risk-free rate, that you can literally loan your money to the government. They can never default on that loan because they have a printing press, and if they ever get short on money, they can simply print more and pay you back. So that is often referred to as the risk-free rate, like I said, and that's really the main alternative that stock market investors have to kind of reference when they're stacking up. Am I better off investing in something that I know the return is going to be X percentage, or am I better off taking perhaps a little bit more risk and putting that into the stock market or an individual company to try and generate a higher return? Now, what we've seen in previous stock market highs and previous stock market bubbles, let's take the tech bubble of the 2000s as an example. That was a period of time where the 10-year treasury bill was returning around 5% to investors. Now, if you're an investor that thinks quite rationally about all these different alternatives you've got in your investment kind of universe, then in order for you to put money to work in the stock market, you're obviously going to have to expect a return much higher than 5%. So if you can get 5% absolutely risk-free, you're probably not going to be willing to put money into the stock market at 6% or 7% or possibly even 8%. You're probably looking for at least 8, maybe 10, 12, 13% a year, something like that, that's substantially higher than that risk-free rate to justify you taking that extra risk and taking on the potential for massive swings in valuations and all those things that a lot of people find quite scary in the stock market. So that was sort of the situation in the 2000s, and it made it very obvious that valuations were extremely high. You had something like an average PE ratio on the stock market of like 30, low to mid 30s. If you invert that, so if we go 1 divided by mid 30s, you're getting about a 3% return, or 3% earnings yield. Compare that to your risk-free 5%, and the stock market suddenly looks very, very expensive. However, that's not the case right now. So right now we're at interest rates which are near enough zero, might as well be zero, sort of 1 or 2% on a 10-year T-bill at this point. And it means that valuations in the stock market at those high PEs can look much more attractive. So if you're getting a 2% return on a 10-year bond, that basically means that you're paying about 50 times earnings for that bond. 1 divided by 2 is 50%, so you're getting a 50. It's sort of like paying 50 times earnings for a company. It's great because there's no risk, but it's terrible because you're paying a massive multiple for a company and that company is not growing. Your 10-year T-bill is not going to return a higher interest rate over time. You're buying it at that fixed 2% rate, you're paying 50 times earnings, and that rate of interest is not growing through the 10-year period that you might hold that bond. Compare that to a business in the stock market. Suddenly something that you can buy at a 3 or 4% earnings yield that also has good growth prospects suddenly starts to look much more attractive. And this is really the fundamental reason why interest rates drive asset prices to such a large extent, and that's why I personally don't think it's fair to look at very basic valuation metrics like a PE ratio and say, oh, we're trading at 30 times earnings or 20 times earnings at the moment and the long-term average is 15. I don't think it's fair it's not an apples to apples comparison because interest rates were so different in previous environments of high pricing. So that's my first thought around interest rates, and that's definitely one of the things that is pushing asset valuations higher, and has done for a long time now, but I think it's definitely something that's a little bit misunderstood, especially by a lot of newer investors, so it's something worth keeping in mind. Now, the second factor is a whole lot of money printing and the potential, at least, for a whole lot of inflation. Now, I will be the first to say that I'm no expert on currencies worldwide or how much we should expect inflation to be over the next few years or anything like that. What I can tell you is that the Federal Reserve in the States has for a long time been targeting a 2% rate of inflation. And that means that, again, when you're getting 2% interest in your 10-year bond, you're basically going nowhere in terms of purchasing power. Your actual number of dollars may go up by 2% a year, but like Warren Buffett wrote about in one of his early partnership letters, if you're making 15% a year and you're in the 80s and you've got inflation of 15% a year, you can't go out and buy any more hamburgers than you would have been able to last year, even though you've got more dollars, because inflation has forced the dollar prices of things up and it's forced the purchasing power of your individual dollars down. Now, I'm not going to focus in this video on telling you whether I think there's going to be rampant inflation or whether I don't think there's going to be inflation or whether I think there's going to be deflation. Frankly, I just don't know. What I can tell you, though, is that some businesses in the stock market are much better set up to be protected against inflation and still have a viable business model than others. And basically all the businesses that are set up to still do well through inflationary periods have either one of two characteristics. So the first thing is they either own a lot of hard assets which are largely immune to inflation. So real estate comes to mind here. If the purchasing power of our dollars is cut in half, that means that generally speaking, over a long period of time, all things being equal, that real estate values will also double. Again, that doesn't mean that if you buy a house today and you sell it for twice as much in a few years' time, and you have double the amount of dollars, that doesn't necessarily mean you're going to have more purchasing power, because at the same time the purchasing power of your dollar has been cut in half. But at the same time, real estate companies and real estate investors are quite immune to inflation, or at least more so than other types of businesses. And one of the great things about real estate investing in particular is that oftentimes you're borrowing money at a fixed interest rate for a very long period of time. And basically you can capture all of the capital gain and inflation on that property without having the same inflation on the debts you have. So let's say, for example, you purchase a $500,000 house, you have $400,000 in a loan because you put a $100,000 down payment. If you have a lot of inflation and your house goes up to, say, $1 million, you still only owe that $400,000, and you're basically paying, and hopefully you're earning more money and getting more rental income now that we've been through a bit of a period of inflation. And the great thing is you're still paying that loan in sort of those smaller dollar amounts with your $400,000 loan. That loan hasn't doubled along with the sort of sticker price on your house. So that's the first type of investment or asset class that is relatively kind of inflation immune and much more inflation immune than other businesses. The second type is any business that has significant pricing power. So the one here that immediately springs to mind is a business like Coca-Cola. Now, Coca-Cola is a company that has a lot of pricing power. If you walk into a shop and you see 3 or 4 different cola beverages on a shelf, and they are all priced at the exact same dollar amount, there is absolutely no way that most people are not going to buy Coca-Cola. If you can get Jim's Cola for $1, and Bob's Cola for $1, and Michelle's Cola for $1, and then Coca-Cola also for $1, you're going to take Coca-Cola every time. And that's because you know what you're getting, you're used to the taste, all these great things about that product. And that's the reason why Coca-Cola don't charge the same price as Bob's Cola and Michelle's Cola. They're more likely to charge $1.20, $1.50, even $2. And they have so much power from their long history of brand, and the fact that people are so used to the taste of Coca-Cola, they have much more pricing power than other businesses, and they can simply charge more money for their product, even when we don't have rampant inflation. But when we do have inflation and the purchasing power of dollars goes down and things generally get more expensive, Coca-Cola can quite easily move their prices up, and that sets that business up really well to survive inflationary periods where other businesses will struggle. So that's the second thing I would look at, and this is something again that Buffett has spoken about in some of his older shareholder letters. He was talking about this a lot in the 80s, that there is definitely a lot of inflation protection with these types of businesses, especially when you compare that to your high capital expenditure type businesses, a lot of infrastructure, and when you're really just in a business of trying to drive costs as low as possible to outcompete others, those businesses aren't quite set up as well to prosper after rampant inflationary periods. But the Coca-Colas of the world, the McDonald's of the world, anything that consumers are more than willing to pay a premium over a non-branded product, they are pretty darn well set up. So those are my thoughts on some of the things driving asset prices at the moment. I think interest rates are highly misunderstood, but really not particularly complicated, at least until they go negative, then things get crazy. But hopefully that gives you some good insights into how I personally think about interest rates and how that relates to valuing different types of assets. And the second thing is, I've got no clue whether we're going to go through a lot of inflation due to the US government printing a lot of money. We might not. Everyone thought we would in 2007, 2008, and it just never happened, and really no one can explain why. So potentially we'll see the same thing again, but I think it's more than likely that we will see at least some inflation over the next few years. And if you intend to be invested in companies through that period, then you've got to look for companies with pricing power. Those are the ones that will be least affected by the detriments of rapid inflation. So those are my thoughts. I do hope you enjoyed the video. If you did, please hit like, hit subscribe. You can watch some older videos over there. Hit subscribe over there, and I will see you in the next one. Cheers.